And if rates are more important than life itself. So if you're here watching on TikTok, Facebook, YouTube, give me a comment, tell me you're here, and tell me where you're at. You can always reach out to me, you can always DM me, and we can chat. But today we're going to dive into something that's really important to me, my business, and what I have done. And the truth is that no one will ever be ready to buy a house at the perfect time. Chasing the market just doesn't exist. So we're going to dive into it. But while you're here, comment, like, throw me some love. Can't wait to jam out with you guys. If if you're a teacher or work for the public school system in Colorado, there's a great video I did last week on this. And we can talk about getting you into a home with up to 25% down payment assistance. But today, if your entire housing plan right now is I'm just going to wait until mortgage rates come down, I want to challenge that. Not because rates can't come down, they absolutely can. But I've spent a lot of time lately talking to people deeply involved in finance, lending, and the economy. And then I went back and dug through the actual economic data. And the problem is this: there really isn't a strong economic case right now for mortgage rates suddenly to become dramatically better. So if you've been putting off buying, selling, downsizing, moving closer to family, getting another bedroom, or relocating because you're waiting for the stars to align, we need a better plan than that. So today I'm going to explain why rates are still high, what would actually have to happen for them to fall substantially, and why the housing market feels stuck. And then most importantly, what buyers and sellers can actually do about it. Because right now the housing market does feel stuck for some, but it also feels very, fluid for others. And it has a lot to do with the inventory, the qualifications of the buyers, and things like that. I have a lot of agents that I mentor and coach, and it runs the gamut. Some people are having the best year ever, some people are having the worst year ever. And it has a lot to do with the inventory, how they operate their businesses, and so on. So let me make something really clear. This is not a buy a house no matter what video. So if you think that's what it's going to be and are thinking about clicking off, just stay here. Throw me a comment. Say you're still here. There are absolutely people who should wait. What I don't want you to do is waiting for something that nobody can promise you is coming. So if you're somewhere in the Denver metro or northern Colorado area and you're trying to figure this out, just simply reach out. We don't have to sign any agreements or anything to have a conversation about your situation, your goals, and what I can do for you. But send me a DM on the platform you're watching this on. Shoot me a text, 303-543-1453, and we can actually model this and help you instead of just guessing. So what exactly are we waiting to get better? Most consumers are waiting for a combination of mortgage rates back around 5%, home prices to fall significantly, monthly payments to become considerably cheaper, sellers to become more motivated, their current home to somehow become easier to leave, the market to finally become normal. That's what people are waiting for. And the truth is that we don't know what normal means, right? We're sitting in this situation and we just don't have that normal, because we're coming off of COVID, low interest rates, everything was absolutely bonkers. You had to bid off crazy, So, and a lot of the real estate agents have gotten into the business in the last 5 or 6 years. And so even the agents sometimes struggle to understand the new market and a different market, and no market is the same. I used to talk all the time when I was coaching agents about how this market, no one's ever been in. So the person with 30 years experience, yes, they've been in markets, but they haven't been in this one. So you as a new agent may have, a better market. So if you're out there hunting and you're like, okay, well, I have this agent that's my best friend, and I just don't know, understand that if they're dialed in and they're working on the market and they're putting out videos like this, they're probably pretty decent, working through that. And the 30 years experience mean absolutely nothing. Right? We're a long way from MLS books and all of that. So here's the problem we keep talking about: the market getting better without actually defining what better means. If you're waiting for 2021 affordability to come back, that's entirely different expectation than waiting for rates to move from 6.7 to 6.3%. The 2.65 mortgage rate reached in January of 2021 was a historic low, occurring during an extraordinary economic environment. Freddie Mac called those rates record lows at the time. I think COVID broke our brains a little bit when it comes to interest rates. 2.5% and 3% mortgages weren't normal mortgage rates. That disappeared. They were crisis era mortgage rates created under extraordinary economic conditions. Building your next 5-year housing plan around the assumption that those rates are coming back is a massive assumption. 30-year mortgage rates, 1971, 2026, with 2.65%, highlighted as a historic low. So let's get into this. This needs to be a big part of what we're talking about here. The biggest myth that we hear, the Fed cuts rates and mortgage rates fall. The reality is the Federal Reserve directly controls a very short-term interest rate. A 30-year mortgage is a long-duration asset whose pricing is much more closely influenced by treasury yields, mortgage-backed securities, investor risk versus prepayment premium, and consumer mortgage rates. The Fed's July 29 target is 3.5% to 3.75%, yet 30-year mortgages were averaging 6.69% this week. Three FOMC members actually dissented in July because they preferred a rate increase, not a cut. The Fed does matter, but Jerome Powell doesn't sit on Thursday mornings, and Jerome Powell's not even the Fed advisor anymore, but he's the one we've had for a while, and type the new 30-year mortgage rate into a computer. Mortgage rates live much further out in the yield curve. Investors are asking, what's inflation going to look like? What's economic growth going to look like? What return do I own this mortgage for potentially decades? How likely is the homeowner to refinance? What can I earn somewhere else? This is all stuff because this is real people's money that they're investing in these yields. And so people are talking about that. This is why you can have a Fed funds rate in the 3s and a mortgage rate pushing towards 7. The Fed itself reported that 10-year Treasury yields have risen this year and that yields on agency mortgage-backed securities, an important component of mortgage pricing, have risen as well. So let's talk here about the real enemy of all of this and the Fed, and it's truly inflation. June CPI was 3.5% year over year, while May PCE inflation was 4.1%, both still materially above the Fed's 2% longer-term objective. The Fed explicitly said in July that inflation remains elevated. This is really a piece people need to understand. Bonds hate unexpected inflation. If I'm lending somebody money for 10, 20, 30 years, and I think the dollars I'm eventually getting back are going to be worth less because inflation stays elevated, I'm going to demand a higher return. Higher long-term yields eventually show up in what you're paying for your mortgage. And this is where the consumer gets caught. A strong enough economy to keep inflation sticky can also keep rates higher. I would absolutely incorporate, this thinking into your strategy. And while I'm not a macroeconomist, I certainly, follow this stuff. And through a good friend of mine, lender Nicole Ruth, she's a great follow on YouTube. She talks about this stuff all the time. She's always talking when these numbers come out and the effect they have on the mortgage rates. The July employment rate released showed payroll employment declining by 23,000, with May and June revised downward by a combined 103,000 jobs. Unemployment was still relatively low at 4.1%. Now, here's where I don't want to oversimplify this and tell you rates can't fall. We got a jobs report literally this week that was weak. And if we continue seeing a labor market deteriorate, economic growth weaken, and inflation eventually cool, that can absolutely put downward pressure on interest rates. But 1 week job report doesn't erase the inflation problem. That's why trying to forecast your mortgage rate 6 months from now is incredibly difficult. Mortgage rates are being pulled in 2 different directions right now. A weakening labor market can pull them down, while inflation and long-term bond pressure can push them up. That's the macroeconomic story in one sentence. For a meaningful decline in mortgage rates, we'd ideally need several things occurring together. Inflation needs to decline convincingly toward 2%. Economic labor demands needs to cool enough that monetary policy can ease. The 10-year Treasury needs to come down. Mortgage-backed securities pricing or spreads improve, or long-term investors become comfortable that inflation will remain contained. Fannie Mae and Freddie currently Fannie Mae currently forecasts the 10-year Treasury around 4.4% for 2026 and 4.6% in 2027, while projecting the average mortgage rate approximately 6.3% in both years. MBA's economist similarly cites resilient economic conditions, persistent inflation, and fiscal pressure as reasons for expecting mortgage around 6.5% for the foreseeable future. Could we wake up next year with a 5% mortgage rate? Sure. Nobody can tell you that can't happen, but that is not the current base case. And the economic event that sends rates sharply lower may also involve weaker employment, weaker consumer confidence, or a recession. The irony is that the economy capable of delivering dramatically cheaper rates might not feel like the perfect economy you've been waiting for to buy a house. This is one of the strongest points I want to make, so let me read it again. The irony is that the economy capable of delivering dramatically cheaper rates might not feel like the perfect economy that you've been waiting for to buy a house. Okay, so now let's take all that from macroeconomics class to housing. And this explains the weird housing market we're living in. People hear low transactions and assume prices have to crash. Those are two completely different things. Nationally, existing home sales are running at a 4.09 million annualized rate in June. Fannie Mae forecasts only about 4.125 million existing home sales for all of 2026, followed by roughly 4.4 million in 2027. That is an improvement, but hardly a return to boom-era transaction volume. Why? It's all about affordability. Higher rates dramatically reduce your purchasing power. Millions of homeowners refinanced or purchased during historically cheap financing. Freddie Mac documented how that gap between an existing low mortgage and today's market materially reduces owners' incentive to move. The results of this is buyers lock out plus sellers lock in equals fewer transactions, not necessarily collapsing prices. This is where Mile High Market Mastery and Why Invest Wednesday separate themselves from the national commentary. June, Denver metro area, 4,024 closed homes, essentially flat year over year. 614,000 median price, up approximately 1%. 12,508 active listings. Pending listings plus 2% year over year. Median market time, 19 days. DMAR also noted that Denver's spring market effectively peaked early, with the new listings and pending activity peaking in April before falling in May and June. Buyers have become increasingly selective of condition sensitive. That's the market. Prices aren't collapsing, transactions aren't exploding, rates aren't providing a bailout, sellers aren't throwing their houses away. We are grinding. And if you've spent 3 years waiting for some giant market event to make the decision obvious for you, the question becomes, how much longer can you wait? How much longer are you willing to wait to put your life on hold? So now that I've spent half of this video telling you why the cavalry probably isn't coming tomorrow, let's talk about the useful part. Because none of this means you should blindly go buy or sell a house. It means we change the question. So please stop asking, when will the market finally be perfect? And start asking, can we build a strategy that makes sense for my life in this market? So let's hear. We're going to start with the steps. Step 1, start with the payment, not the purchase price. I don't really care what you're approved for. I care what the payment you can comfortably live with is. And once we establish comfortable monthly housing, emergency reserves, down payment, credit optimization, expected ownership timeframes, taxes, insurance, and HOA, not merely principal and interest, right? We have to understand all of those things that come into what we see as a mortgage payment on one bill. I never want somebody buying a house where the financial plan requires a refinance. Refinancing someday is an upside. It cannot be the thing keeping today's deals alive. If rates fall, fantastic. If they don't, the household remains financially comfortable because they're not just banking on that to happen in 2 or 3 years when you have another kiddo and so on. This market can give buyers something 3% rates didn't, and it's negotiating leverage. I'm telling you right now, I'm getting clients into better homes, turnkey homes for discounts every single day. If you're interested in learning more how to do that, let's have a conversation because it's absolutely possible. Seller concessions, closing cost assistance, temporary rate buy downs, permanent rate buy downs, then the break even works, right? Inspection leverage, price negotiations, builder incentives, longer decision windows, assumable FHA, VA, USDA financing where available and workable. A lot of those Govy loans, FHA, VA, especially in our market here in Denver, used to not be so were almost frowned upon when you were putting in information there. So that's absolutely part of what we're doing here to understand what is going on. And so we want to make sure that the financing is 100% ready to go, but now we don't necessarily have to shove you into a conventional loan that maybe you weren't even worried about. So let's talk about this. Let's talk about the payment example, right? $550,000 purchased with 20% down at approximately a 6.55% interest rate. I'm just using that as an average. Completely pulled it off the internet, so I'm not a lender, so don't go there. That's a $2,796 a month with just P&I. Then you add on taxes and insurance and so on, but we're just going to stick with P&I for this one. A 3% price reduction to $533,500 is around $2,712 a month P&I. So as you can see, that price reduction is only about $84 a month savings. A meaningful rate incentive can affect the payment much more dramatically, which is why buyers and sellers should compare concessions versus price reductions rather than automatically demanding a lower purchase price. Buyers live in the payment, sellers tend to live in the price. Good negotiation is figuring out how to bridge those two and bring people together. This is critical for trust. And there are people listening to me right now who shouldn't buy. If today's comfortable payment doesn't get you something that actually solves your housing need, if buying wipes out every single dollar you've saved, if you're likely going to move again in the next 18 months, not knowing what the market is, or you're relying on appreciation or a refinance to bail you out, don't buy yet. Let's build the plan so that when the numbers work, you're ready. Sellers have the exact opposite problem. A lot of you are scared of selling the house. You're more scared of giving up the mortgage. Correct. So don't dismiss it. Let's just go, right? So why are we considering selling? Family, schools, job, divorce, downsizing, upsizing, relocating, aging, first house, financial strain, lifestyle, investment opportunities. Is preserving my current interest rate more important than solving the reason I want to move? Sometimes the answer is yes, and staying is the right strategy. However, let's zoom out a little bit. Let's talk about the entire move, the old house, the mortgage balance, right? Current payments, equity, maintenance, taxes, insurance, suitability versus a new house, negotiated price, financing, seller concessions, as well as equity carried forward. New taxes and insurance is sometimes higher on newer homes, and lifestyle improvement. So giving up 3% mortgage doesn't automatically mean you're making a bad financial decision, and keeping a 3% mortgage doesn't automatically mean you're making a good life decision. We have to run the whole equation. What's it look like? What's going on for you? And that's absolutely massive. This may be the strongest part of this video. Today's buyer is payment sensitive, so sellers should evaluate option A, a price reduction. Option B, seller paid closing costs. Option C, seller paid temporary buy downs. Option D, seller contribution towards the permanent rate reduction, financially appropriate. Repairs, improvements that remove buyer's objections. So here's the deal. There's a lot of options there. All of those are either a price reduction or a seller concession. But as a seller, pricing right out of the gate and strategically is huge. And we have to understand we're not in the era that we can just price a home and get $50,000 over, like maybe you heard about or maybe you were involved in when you bought the home. And so that's absolutely massive. A $20,000 price reduction sounds sexy on Zillow, but depending on the financing, $20,000 used strategically toward affordability may create a much bigger emotional and financial difference for that buyer. And Denver buyers are particularly condition sensitive right now. DMAR reports move-in ready properties receiving a growing premium as buyers become more selective. For current owners moving into another home, explore equity available at sale, larger down payment, recasting after the existing home closes, bridge financing where appropriate, HELOC strategies where appropriate and qualified, sales contingencies, extended occupancy, post-closing arrangements, temporary housing, assumable, financing and opportunities, whether retaining the current property as a rental actually works mathematically. As you guys know, that's my favorite one. But the important piece is financing strategies need to be modeled with a lender. Tax implications go to the CPA and tax professional. I'm not one of those people. However, I do know a $20,000 concession on a $500,000 property is far more, usable in the affordability conversation than a $20,000, price reduction to $480,000 with no affordability support. There isn't one magic strategy here. The goal is to put 4 or 5 options on the table and find one that solves your specific move with the least financial friction. I'd close every, conversation with okay, great. We've talked about the market. We've done all of that. Now what? So, does your current home still fit my life? Can I comfortably afford the alternative today? Can we improve the transaction through negotiation or financing strategy? Would I still make the decision if rates didn't improve for 3 years? That fourth question is everything. If the answer is yes, if the house works, the payment works, and the move improves your life, then a future refinance is just a bonus. If the answer is no, because you're banking on rates falling next spring, we don't have a housing strategy. We have an interest rate bet, and your family shouldn't have to make major life decisions based on an interest rate bet. So my message today isn't buy now, it isn't sell now. And it's definitely not mortgage rates can never come down. My message is stop waiting for economists, the Federal Reserve, or the bond market to give you permission to live your life. If you need another bedroom, need to downsize, want to move closer to family, need a different school district, or are relocating, or you're simply trying to figure out whether a move makes financial sense, let's actually run the numbers. We can look at your current home, your equity, your mortgage, today's payment on the next home, possible seller concessions, financing strategies, and what staying put looks like too. And if staying is the better decision, I'll tell you that. Reach out with any questions about Denver, suburbs, Northern Colorado, or if you're exploring areas to move, let's build the plan around your life instead of waiting for the stars to align. We'll see you next time.